Have you ever felt that sudden pressure to buy or invest in something just because everyone else seems to be making money from it? We've all felt it. You open your phone and the market is exploding upward. Social media is flooded with profit screenshots, and suddenly it feels like the world is moving forward without you. That pressure in your chest, the urge to click buy before it's too late, that's FOMO, and it is one of the most expensive mistakes investors make. In this video, we are going to break down what FOMO really is, how to recognize it in real time, and why it keeps people like you buying at the worst time. More importantly, we will show you how to step away from that cycle and move into a simple, calm, repeatable system that smart investors use to build long-term wealth. One that doesn't require watching charts all day or stressing yourself over market performance or liquidations. But before then, let's look at what FOMO is. FOMO is when you buy after the price has already spiked, not because the math makes sense, but because you're afraid of being left behind. At that point, you're not buying value. You're just reacting to momentum. In simple terms, FOMO is buying the hype after the opportunity has already passed. It shows up mainly during bull markets, not during crashes, for one simple reason, which is that people feel safe when the market is rising. For instance, when the prices are going up, you will notice that fear disappears and confidence takes over. For example, when the crypto or stock market is surging, you will notice that influencers always have a reason to tell you to buy. You will always see posts like, "This is just getting started," or "Still early." Buy now before the price explodes. These posts are often accompanied by screenshots of profits. A real-world example of this played out with gold and silver in January 2026. As prices of these precious metals surged, people rushed to buy, not because they understood what was happening or what was triggering the rally, but because prices were going up. Influencers rushed in with explanations. Some linked it to geopolitics. Others called it the future. Only very few people stopped to ask a simple question. Why now? Well, a few days later, on January 30th, the mood shifted. And in a single day, silver collapsed, dropping sharply by over 35%, while gold followed by over 13% dip in a single day. And over $3.15 trillion was wiped out from the gold and silver market cap in a single day. Millions were liquidated as late buyers rushed for the exit. Although billions were lost, remember that the assets themselves didn't suddenly change overnight. What changed was sentiment. That's how FOMO works. Rising prices create a false sense of security. Waiting starts to feel risky, and buying late starts to feel smart. That's when people stop asking, "Does this make sense?" and start asking, "What if this keeps going up without me?" And that moment, when fear of missing out replaces thinking, that's the trap. To understand why FOMO is so powerful, we first need to understand what it does to the human brain. Let me share a real-life scenario. In mid-January 2025, the crypto market was heating up fast. Prices were already moving, timelines were loud, and optimism was everywhere. The US election was over, a new president was about to be inaugurated, and the mood across crypto was clear. Everything was expected to go higher. Then the US president tweeted about the Trump coin, and the hype went into overdrive. Buying accelerated. Influencers flooded timelines with bold claims. Some said crypto was about to dominate everything. Others called it the start of a new cycle. At that point, pressure kicked in, and I convinced myself it was the right time to buy. Not because I had a clear edge, but because the story felt convincing and the timing felt urgent. So I bought Solana, one of the most popular altcoins at the time. Well, at first my portfolio was rising, and it felt good. Then the reality hit. The tariff war news broke and the market collapsed. Prices dropped fast. The same confidence that pulled people in vanished overnight, and the bullish narratives went quiet. That's when it became clear. I didn't buy with a plan. I bought it with emotion, and that's the lesson. FOMO doesn't come only from a lack of knowledge. It comes mainly from reacting to noise, narratives, and crowd confidence. That experience forced me to ask a deeper question. Why does FOMO feel so irresistible even when we know better? And the answer starts in the human brain. What that experience showed me is this. FOMO has nothing to do with intelligence. It happens in the moment when the price is moving and time feels limited. For instance, think about what actually happens when you're watching a chart during a rally. A green candle appears, then another. Your phone lights up. Notifications come in. Someone posts a chart. Someone else posts a profit screenshot. Every few minutes, the price is higher than the last time you checked. Each move feels small, but together they create momentum, and momentum feels good. That feeling isn't confidence, it's a reward. Your brain gets a hit every time the price moves up, the same way it does when someone wins a bet or gets a notification. You're not thinking about risk, you're thinking about profits. As the price keeps rising, your brain quietly starts rewriting the story with questions like, "This must be safe. If it was risky, it wouldn't be going up this fast. I can always sell later." That's how rising prices get mistaken for certainty. Now add other people. You scroll and see others celebrating wins. No one is posting losses. No one is talking about risk. The crowd looks confident, relaxed, even casual. Your brain reads that as reassurance. You begin to wonder, if everyone else looks comfortable, why shouldn't you be? This is the social proof trap. The crowd doesn't make an asset safer. It makes you less cautious. The more people pile in, the less room there is for error. That's why FOMO peaks when things feel obvious. Not when price is low and uncertain, but when confidence is high and patience is gone. By the time buying feels easy, your thinking has already stopped. That's why you have to remember this. Markets don't move because everyone agrees. They move because different players are doing different things at the same time. On one side is the crowd, the 90%. These are retail investors reacting to price. They buy when charts look strong, when narratives are loud, and when confidence is high. Their entries usually happen after most of the move has already occurred. On the other side is the 10%, institutional money, funds, desks, and early participants who entered when prices were quiet and conviction was low. They don't chase strength, they sell into it. This is the dynamic most people never see. When the crowd is buying aggressively, someone else has to be selling. Markets don't go up because buyers appear out of nowhere. They go up because earlier buyers are distributing their positions to later ones. That transfer has a name. That's where exit liquidity comes into play. Exit liquidity sounds technical, but it's simple. It's when your buy order provides the demand that allows someone else to get out. When you FOMO into a trade after a strong run, you're not entering at the beginning. You're stepping in as the exit door for someone who bought months earlier at a fraction of the price. That's why tops feel calm before they collapse. Selling doesn't look like panic, it looks like strength. This is why when the crowd sees an opportunity, smart money sees inventory to unload. And once you understand that late buying isn't participation and that it is facilitation, your perspective shifts. In essence, once you realize you're being used as someone else's exit strategy, your entire way of seeing opportunity changes. And to break FOMO, you don't need complex charts. All you need is everyday logic. For example, think about how you behave in a phone store. If a phone you want to buy suddenly becomes 20% more expensive overnight, you don't rush to buy it. You pause. You ask why. You wait for a discount, or you walk away. But in the markets, people do the exact opposite. When a stock or coin jumps 20%, suddenly it feels more attractive, not less. Price goes up, and demand increases. The same logic that protects you as a consumer disappears when you become an investor. That's the price versus value paradox. In real life, higher prices trigger caution. In markets, higher prices trigger urgency. In essence, FOMO flips common sense upside down. Rising prices are mistaken for proof, even though they often mean higher risk and less upside. By the time an asset feels safe, it's usually because it's already expensive. So the real problem isn't the price, It's you timing your entry under emotion, and that's exactly what the 24-hour cooling period is designed to fix. Anytime an asset is being hyped, online, on the news, or in group chats, the rule is simple. Wait 24 hours before buying. No exceptions. That pause does one thing. It gives your emotions time to fade. And when you give it time, something interesting happens. The emotion fades, the urgency drops. The story doesn't sound as convincing anymore. By the end of the day, you might realize you don't need to invest in the stock or coin in the first place. That's what time does. It brings logic back into the room. In essence, if you can control your clock, you can control your capital. And once you slow the process down, you start to notice something important. Remember this. Most of the stress in investing doesn't come from markets. It comes from the way we're trying to win in them. Which brings us to the next question. Why keep guessing the charts and chasing the next 10x coin when you could invest in a simple, calm, repeatable system that smart investors use to build long-term wealth? One that doesn't require watching charts all day or stressing yourself over market performance or liquidations. That's where the stock market comes in, and more specifically, the S&P 500. The S&P 500 isn't exciting. It doesn't pump overnight. It doesn't trend on social media. It simply represents the largest and strongest companies in the U.S. stock market. Companies that grow, fail, and get replaced over time. You don't need to predict which company will dominate the future. The index does that for you, and that's the protection most people are missing. When you stop betting on single winners and start owning the entire market, you shield yourself from the pressure to chase, guess, and react. That's what I call the index fund shield. And this is where ETFs come in. An ETF, exchange-traded fund, is a single investment that holds many assets at once. When you buy one, you're not betting on a single company or narrative. You're buying a slice of the entire market. That's powerful, right? The beauty of investing in an ETF is that you don't need heavy research or constant monitoring. The diversification is built in. For instance, if you invest in a broad market ETF like VTI, you gain exposure to thousands of stocks across the US market. Unlike crypto, where one bad decision, one headline, or one narrative shift can wipe out an entire position, your risk here is spread across the entire economy. Outside that, you can also choose sector-based ETFs, such as QQQ, which tracks the NASDAQ 100, and gives you exposure to many of the largest technology-focused companies. With the ongoing AI-driven rally in the tech sector, QQQ lets you benefit from that growth without the stress of trying to handpick the perfect individual stock. But for someone who prefers regular income, dividend-paying ETFs like SCHD, VIG, or VYMI can provide steady payouts while still allowing your investment to grow over time. Apart from these, there are other popular ETFs to invest in, like VOO, SPY, and VUG, which track broad sections of the market and focus on long-term growth. Either way, you're no longer relying on a single story to be right. And this structure unlocks something important. You don't need perfect timing anymore. That's where dollar cost averaging, DCA, comes in. Instead of trying to guess the best entry, you invest consistently, weekly, monthly, automatically. You buy during rallies, you buy during pullbacks, you buy when the market is quiet. And as your investment grows, it can also start generating income. And instead of spending that income, you can reinvest it right back into the same system. That's where compounding begins. Compounding isn't about speed, it's about repetition. Small gains stacked on top of each other, quietly doing the work you used to chase. Over time, those gains begin to generate more gains, which generate even more gains. That's how smart people quietly build seven-figure portfolios, without noise, without hype, and without living on a price chart. The beauty of ETF investment is that the pressure to get it right disappears. Participation replaces prediction, and time becomes your biggest advantage. Although ETFs are often called boring, that's exactly why they work. They don't put you on an emotional roller coaster. Like, for instance, if you've been in crypto long enough, you know the opposite feeling. You wake up to a green portfolio. You're up $5,000. It feels real. It feels earned. You start thinking about what comes next. Then you check again a few hours later. A headline drops. A tweet goes viral. One narrative flips. And just like that, 30% is gone. Sometimes more. Not over months, but rather in a single day. The gains you celebrated yesterday are erased before you've even processed what happened. That kind of volatility isn't rare in crypto. It's normal. Think back to the October 10th, 2025 market crash. In just a few hours, billions were wiped out across the crypto and stock markets. Portfolios bled, panic spread, timelines went silent. For a moment, everything looked broken. But what happened next is the part most people overlook. Within weeks, the stock market stabilized. The S&P 500 recovered and eventually pushed to new highs. The drop turned into an opportunity. Meanwhile, crypto didn't respond the same way. Instead of recovering, many crypto coins continued to slide. People kept waiting, kept hoping. Every small bounce was followed by another dip. What started as a drawdown slowly turned into exhaustion. That's the difference. Crypto demands patience and perfect timing. ETFs reward patience alone. While crypto investors were watching charts and waiting for a recovery that never quite came, ETF investors were doing something simpler. They were buying the dip automatically. No panic, no second guessing, no need to predict the bottom. That's how smart investors build seven-figure portfolios. Quietly, patiently, and without chasing noise. Now you know that FOMO isn't an opportunity. It's a signal to pause, step back, and think long-term, instead of reacting in the moment. Remember, this is not financial advice. Investing is risky and can wipe out your portfolio if you don't know what you are doing. Do not invest what you cannot afford to lose. And above all, always do your research before investing. If you found this video helpful, like, share, and subscribe. Thank you.